Very good afternoon, guys. We start with the next chapter of your management accounting ratio analysis, which is also called as analysis and interpretation of data part 2. Part 1 was your vertical financial statements, what you did. This is the second part. Commonly, this chapter is called as ratio analysis. Now, guys, understand very carefully. This is a very important chapter, not only from your syllabus point of view, but also in practical life. In practical life, when students go for, after graduating and after further study, they go for corporate interviews. If you are applying for any job connected with finance or accounts department, especially finance, ratios ka questions are asked in your interviews. So remember one thing. This is a formula based chapter, but every formula has a logic. So don't try to mug up the formulas, but understand the logic and see what is the concept of this chapter. When I do this chapter, as and when we proceed, each and every formula, I'll explain you logically what is the purpose, what is the meaning of that formula, and how it is to be applied and how it is to be used in financial decision making. So understand this. That is the reason I'm mentioning this in advance only before I get into this chapter. Okay, so please keep this in mind. Again repeating, this is a formula based chapter, but every formula has a logic and it is very interesting. Coming to the chapter. As I said, the name of the chapter is ratio analysis. Now, ratio analysis means nothing but it is a financial yardstick, or it is a yardstick which gives you an important base. It gives you calculations where you can judge the financial position and profitability of the company. It is a yardstick used to judge the financial position and profitability of the company. Very important. This is there in BAF, this is there in BMS, this is there in BCom and all other courses which are connected in finance. Also it comes in post-graduation and professional level. Of course there the level will be high as compared to what you all are doing here. Okay, now see, as I told you, it is nothing but financial yardstick. It's given in the theory what you'll have, used to judge financial performance, or you can say financial position and profitability of the company. That is financial performance only. Now, ratios are further classified in three main categories. There are different classifications, but right now I am sticking to the major classification for which the chapter is based upon. Ratios are classified in three major categories. First is balance sheet ratios. First is balance sheet ratios. Now, why this is called as balance sheet ratios? The reason is these ratios can be found out from the balance sheet. That means you don't need your income statement, you don't need your trading P&L to get these ratios. Whichever are the balance sheet ratios, there are total 6. So all those 6 balance sheet ratios you can find out on the basis of balance sheet. Therefore, it is called as balance sheet ratio. What are the ratios? That slowly we'll get into the chapter. Second, it is called as income or revenue statement ratios. Second, income or revenue statement ratios. These ratios you can find out from your trading P&L or your vertical income statement. You don't need balance sheet for that. Therefore, it is called as income or revenue statement ratios. These ratios are also called as profitability ratio and expenses ratio. Ratios connected with finding out of profitability, finding out the expense percentage, that comes in this category. Understand? First, balance sheet ratios, you need only balance sheet. You don't need income statement ratio, income statement. Therefore, called as balance sheet ratios. Here, you need income statement or you need trading P&L. You don't need balance sheet. Therefore, it is called as income or revenue statement ratios. Here there are around 8 to 10 ratios. And the last one, combined ratios. Here there are total 6. But one ratio is further classified into 4. So it goes to 8 to 10 ratios. Last is combined ratios. Now why it is called as combined? Because it is combination of balance sheet and income statement. That means to get this each combined ratio, you need few figures from balance sheet, you need few figures from income statement. Therefore, it is called as combined ratios. Got it? So combined ratios are the ratios which is a combination of balance sheet and income statement, and you need figures from both balance sheet as well as income statement to get a particular combined ratio. Brushing up all three again. Balance sheet ratios you can calculate only from balance sheet. You need only balance sheet. Income statement, revenue statement ratios, you need income statement, that is trading P&L, you can get from there. Combined way, you need balance sheet as well as income statement to get the ratios. Apart from this, there is another classification which is given in the theory. I am not getting into that right now because your practical sums currently are not connected with that. That is more important from theory point of view. But at a later stage of this chapter, I will definitely discuss the things with you all. Now see guys, these are the three categories of ratios. Now today what I will be starting is balance sheet ratios. What I told you, ratios which are connected with balance sheet are called as balance sheet ratios. Initially, 3 to 4 sessions, maybe up to maybe 1 or 2 more, we will focus only on balance sheet. So few days we will take only balance sheet, couple of days we will take income statement, and another few days towards the end we will focus on combined ratios. A few days we will focus on combined ratios. Got it guys? So this is the way we will approach. Now let's focus only on balance sheet ratios type 1, that is balance sheet ratios. We know ratios which can be found out only on the basis of balance sheet is called as balance sheet ratios. Now these balance sheet ratios are further classified in 6 categories. We will be doing each and every of those 6 ratios. But in the first sum today, I will not do all 6 together. I will just take 3, and in the next class we will take the remaining 3, and after that we will solve all together in the next few sessions. Okay, now see, balance sheet ratios, you all know the meaning. 6 categories. First is current ratio. The first of the ratio is current ratio. I am just discussing the first 3 right now, because if I discuss everything it will go bouncer. So I am just discussing first 3 right now because that is what we are going to do in the sum, what I am going to do with you. First is current ratio. Your first ratio is current ratio. Balance sheet ratio. See that here, keep that here in front of you. Now current ratio is the ratio which is used to judge the short-term financial position of the company. Current ratio is the ratio which is used to judge the financial performance of the company from a short-term point of view. That means it helps you to judge a short-term financial position of the company, whether it is good or no. Current ratio is the ratio which helps you to judge the short-term financial position of the company. As I told you, this is a formula-based chapter. Current ratio का formula is current assets upon current liability. When we solve, I'll write the full formula. It is current assets upon current liability. That means proportion of current assets to current liability. Now listen, there are some standard norms, not for all ratio, but for majority of balance sheet ratios. Now, when I say short-term financial position, you all have done earlier also. I discussed with you all while solving the vertical balance sheet. There is no legal definition of short term and long term, but analysts have concluded that anything which is for a period of less than 1 year is treated as short term, and anything which is for more than 1 year is treated as long term. Anything which is for less than 1 year is short term, and anything which is for more than 1 year is to be treated as long term. So here, when I say short term financial position, that means financial position for a period for less than 1 year. Less than 1 year will be treated as short term. Now, there will be few sums, not all, where you have to give your comments that what do you interpret for the financial position of the company. That is what I am going to do in today's sum, where I am taking 3 ratios, of which the first is current, which gives you short term. Then there is one ratio which gives you immediate, and the other one gives you long term financial position. So that is the reason I am just doing 3 ratios in this first session. Now, if they tell you how the current ratio is going to be useful for you all in judging the financial position, so keep that in mind. Analysts have set a benchmark of a standard current ratio of 2:1 minimum. That means if your current ratio is 2:1 or more, your financial position, your short-term financial position is good. Now, when I say more than 2 or 2 is good, that doesn't mean it should be too high, because a very, very high current ratio has a drawback, because since current ratio includes current assets and current liability, high ratio means high current assets. So you should not be having high current assets in the form of stock, because you have too much of stock, which indicates that you are not able to sell the product. So too high ratio is also not good. It should be 2 minimum, 2:1. Anything above that is good, but not very high. You can see the theory in front of you. I've explained in that. Of course, when you do the sum, I'll explain you. So this was first current ratio. Second ratio is quick. We also call it as liquid. We also call it as asset test ratio. So the second ratio has 3 names. It is called as quick ratio, also called as liquid ratio, also called as asset test ratio. 3 alternate names for this. Commonly it is called as quick or liquid ratio. Asset test ratio word we don't use in the formula, but you should know because it is important from objective point of view. Now, as I discussed, current ratio is used for judging the short-term financial position of the company. Current ratio is used for judging the short-term financial position of the company. Similarly, quick ratio or liquid ratio or asset test ratio is used for judging immediate financial position of the business. Immediate. Now listen, what is the difference then between short-term and immediate? Short-term means less than 1 year, and immediate generally means less than 3 months. That means instant, maximum period of 3 months. Again, I am repeating, there is no legal definition, but analysts have set a benchmark. Less than 3 months or up to 3 months is immediate. More than 3 months up to 1 year becomes short term, and anything above 1 year, that becomes long term. So current ratio, short term financial position, more than 3 months, less than 1 year, immediate financial position up to a period of 3 months. Current ratio ka formula was current assets upon current liability. Quick ratio ka formula is quick assets upon quick liabilities. When I solve, I'll do in detail. It is quick assets upon quick liabilities. Now, if you'll recollect the first chapter vertical, there were few sums where we calculated quick assets and quick liabilities. Quick asset means on the spot it can be converted into cash. Uska formula is quick assets upon quick liabilities, in which quick asset means your total current assets. From that, you deduct stock and you deduct your expenses paid in advance, that is prepaid expense. From current assets, you deduct stock and you deduct expenses paid in advance. Logic is, stock you can encash only when you sell it. So till the time it is not sold, you cannot say it is instantly realizable. At the same time, expenses paid in advance. Money has already been paid. You have to just get the service. So that is also not quick. So quick means current assets minus stock minus expenses paid in advance. Now keep this in mind. To get quick assets, if from my current assets I am deducting stock and expenses paid in advance, so stock and expenses paid in advance, what I have deducted, becomes non-quick. So from current, deduct non-quick, that will give you quick assets. Keep that logic in mind. Got it, guys? So that is quick assets. Current assets minus stock minus expenses paid in advance. So expenses paid in advance and stock which you have deducted from the current assets to get a quick one become non-quick. So stock and expenses paid in advance, non-quick. What is the formula? Quick assets upon quick liability. Now what is quick liability? Quick liability ka formula is current liabilities minus income received in advance minus bank OD. Current liabilities minus bank overdraft minus income received in advance. Now bank overdraft, you all know, it is a short-term borrowing from bank. If as a businessman you are having an account, so you get overdraft facility, we commonly call it as OD. OD matlab you can withdraw more money from your bank. Bank gives you short-term loans, but overdraft facility is available only for corporates and businessmen. Now overdraft ka amount keeps on changing. So that is the reason it is to be treated as a non-quick liability. And income received in advance, same logic of prepaid. You have already got the money in advance, so now you are going to serve. You have already got the money in advance, so now you are supposed to serve. So from your current liabilities, deduct bank overdraft, deduct income received in advance. So current ratio, current assets upon current liabilities. Current assets are short-term assets. Current liabilities, short-term liabilities to be payable within a period of 1 year. And as I told you, quick assets generally less than 3 months. Formula, quick assets upon quick liabilities. Quick assets is current assets minus stock minus expense paid in advance. So stock and expense paid in advance become non-quick. Current liability, quick liabilities, current liabilities minus bank OD minus income received in advance. You have deducted these two, so bank OD and income received in advance becomes non-quick liability. Coming to the third one, there are 6, but I am focusing right now only on 3. It is called as proprietary ratio. It is called as proprietary ratio. Now, as I told you, current ratio used to judge short-term financial position, quick ratio, immediate financial position, and proprietary long-term. Yeah, before that, sorry. Quick ratio is immediate. What I told you, current ratio ka standard trend is 2:1. Similarly, quick ratio ka trend is 1:1. That means if your quick ratio is 1:1 or more, it is very good. Higher the quick ratio, better it is. That means you can instantly encash your money wherever you want. So current ratio ka standard 2:1, quick ratio ka standard 1:1. Anything above is good. Now proprietary ratio is used to judge long-term financial position. Current ratio short-term, quick ratio immediate, and proprietary long-term. As I mentioned, long-term means nothing but anything above 1 year. So anything above 1 year is your long-term, and that is a strong base because normally shareholders, we are going to do this for companies, shareholders are not concerned, majority of the shareholders are concerned with a long-term horizon and not for short-term, because short-term mein paisa aayega jayega, you might get good profits, then next you may not get. So if a smart investor is there, he will always think from long-term point of view and will not be excited with short-term benefits. Now proprietary ratio ka formula is, you need proprietors funds and you need total assets. So proprietary ratio is equal to proprietors funds upon total assets. proprietary ratio is proprietor's funds upon total assets. Now, what do you mean by proprietor's funds? You will have done vertical financial statement. Proprietor's funds is share capital, that includes both equity preference plus all your reserves, because reserves and surpluses are your profits created, it belongs to the shareholder. From that you will deduct miscellaneous expenditure. So you all have done the vertical format. Even in the first sum what we are going to do, vertical format is which I have already prepared, I'll discuss and then we'll calculate ratios from there. So proprietor's funds is share capital plus your reserves minus deferred expenses, which we call it as miscellaneous. Miscellaneous we have discussed earlier, expense you have incurred but benefit of which you will get over a period of years. Preliminary expenses, discount on issue of shares, discount on issue of debentures, accumulated losses, that is your debit balance of P&L appearing on the asset side, all they are miscellaneous expenditure. Format, those who don't remember, please go back and see the first video of vertical financial statement. I have explained the format in detail there. Got it guys? So this is the thing. Current ratio short term, quick ratio immediate, proprietary long term. I told you current ka standard 2:1, quick ka 1:1. Now proprietary doesn't have an exact standard. Now understand one thing. When I say proprietor, proprietor means owner of the company. There are two things, owner and the other person from whom you have borrowed. Now if the company is using money, majority funds, if it is owned by them, that is better. But if majority of the funds you have borrowed, then there is a question mark on the long-term financial position. So higher the proportion of owner's funds and lesser the proportion of borrowed funds is a good standard for long-term stability. Sometimes now, you all have not studied till now direct tax. Of course, few of you all have studied. Direct tax mein it is income tax. One of the part of direct tax is income tax. Now for companies if you pay interest on loan, you get tax exemption. But if you pay dividend on shares, you don't get tax exemption. So it is always better that some part of debt should be there, because anyway on shares you have to pay dividend, here you have to pay interest. So interest pay you get tax benefits. So sometimes it is always better to have some part of loan. Not always, but not full, but some part of loan. If it is there, it gives you the benefit of taking tax advantage. That we accounting language we call it as trading on equity. Trading on equity means there should be a balanced proportion of your owner's funds and borrowed funds. So proprietary ratio may, if the majority of the funds are financed by proprietor, then the long-term financial position is good. So when I say majority, more than 50% becomes majority. So anything above 50-60% shows a good proprietary ratio, a good positive sign for long-term financial position. So keep that in mind. There is no exact trend, but majority proportion of your total assets, if it is financed by proprietor, it is considered good. Now what I told you formula, proprietary ratio is equal to proprietor's funds upon total assets. Now when I say total assets should mean fixed assets plus your long-term investments plus your current assets. Total assets will not include fictitious assets. I'll repeat, total assets will include fixed assets, that is after deducting depreciation, investments, that is long-term, and your current assets. So my proprietary ratio is proprietor's funds upon total assets. I repeat again, proprietor's funds share capital plus reserves and surplus minus fictitious or miscellaneous expenditure as per your format, and total assets is fixed assets plus long-term investments plus current assets. If my proprietary ratio is 0.5, 0.6 or more, then it indicates a good long-term financial position. Now guys, listen this. There will be few sums where I'll be making you write the comments. Now there is no standard comment for any sum, even in practical life. Comments will vary from analyst to analyst. So there is no exact answer for comments, but when you write, you should see to it that it should make sense. Now when I am going to dictate comments, I am going to make it very simple for you. So you can just understand what I am trying to explain, and then I will make it simple. I will dictate in a simple words. If you all can follow that, that will be the best thing to write in the exam. Because in exams, every student will have a different comment. Comments will keep on changing, but we'll try to stick to one trend. That we will see when I make all write comments for the first sum. As I told you, I'm going to make it very simple for you. Now listen, these were the 3 balance sheet ratios. As I told you, there are 6, but I'm not getting into the 4th, 5th and 6th one right now, because in the first sum, I'm going to do only these 3. So those 3, we will take it in the next class. Next class we will do all 6 together, and after that all the sums we'll try to calculate as many ratios as possible according to the information given in question. But mostly I'll try to take all the 6 ratios in the remaining question so that you get a good revision of each and every ratio in the next few sums. Now I'm taking the first sum of your sheet where the balance sheet is given. You have to convert in the vertical format and then get the ratios and give your interpretation, that is conclusion. Now the board is full. I'll just pause the video. I'll take the picture of this and I'll be back in some time. Okay guys, as I mentioned, I'm continuing with the first question. Now see, the balance sheet is given, the name and date is not given. Items: equity, share capital, preference share capital, debentures, tax provision, creditors for goods, bills payable, creditor for expenses, general reserve surpluses, building stock, plant and machinery, furniture, land, cash at bank, debtors, prepayment. Now see, after prepayment, the next item is bill receivable. It might be corrected in few sheets, it may not be in few. So what you do? Cancel bill receivable, cancel the word bill receivable, and instead of bill receivable, write there preliminary expenses. I'm just doing it purposely to cover a variety for proprietary ratio. I'll repeat. Asset side pay, the last item is bill receivable. Cancel the word bill receivable and instead of that write preliminary expenses. Rearrange the balance sheet in a suitable form for analytical purpose. Vertical balance sheet, what we did in the first chapter, and compute the current ratio and liquid ratio and offer your comments. Now they have asked you only current and liquid. Add there, also calculate proprietary ratio. That means we are calculating all 3, current, liquid and proprietary ratio. Add there proprietary ratio also, because if we do these 3, they have told you commenting, so we get short term, long term as well as immediate financial position. Now see guys, vertical format I have already drawn. I am not wasting time on this video for preparation because you all know it. We have done in multiple sums in the first chapter. But again I will give you the brush up. This vertical balance sheet. Now keep one thing in mind. The vertical balance sheet in this subject, management accounting, is different, and the company's balance sheet, what you all are doing in financial accounting, is different. Both are different. Don't try to merge it. Of course, few heads are same, but few subheads are same. But then you have to be cautious. You should know the difference between the two. Again, I am repeating. This is the format used in management accounting, and the other format is used in financial accounting, that is Companies Act 2013, according to Schedule 3. This is just for analysis purpose. I have mentioned earlier also while doing this chapter, this is not a legal format. This is a format used for financial analysis by the analysts of different countries. Of course, in your syllabus, we have to stick to this format. 2 parts: sources and application of funds. Sources, from where the money comes in. I'm just making it because we have done this in detail. Sources means from where the money comes in. Sources in 2 parts: proprietors funds, borrowed funds. Proprietors funds is that what belongs to you. Borrowed funds is what you have borrowed. We discuss right now. Proprietors funds is share capital plus reserves and surpluses minus fictitious assets. In this sum, share capital may preference equity. So I am putting them in the first column, taking the total in the second column. Reserves and surplus may you have to see the liability side. Now you all know what is reserve. We have done this in the first chapter. General reserve and surpluses both are your reserves. 25, 5, 30. 150 plus 30 you get 180. Asset side pay, purposely added fictitious asset, that is preliminary expense for this only. Less miscellaneous expenditure to the extent not written off. Now had I not changed that, this would have been there. but I made bill receivable into preliminary expenses. So preliminary expenses 2000. So 150 share capital, that is equity plus preference. 30 reserves and surplus, that is general reserve plus surplus, gives you 180. And from that 180, deduct preliminary expenses 2. So 180 minus 2, you get outside 1,78,000. This is your proprietor's funds. Now one good thing is that, you know what, in case you are converting the vertical format, your ratio ka calculation become much simpler. Of course, drawing the format will take time, but in your exams, you will draw this only when the question says otherwise no. Hardly 2 or 3 sums is what we will be doing, where we will convert the format, balance sheet, income statement, and then get the ratios. Majority of the sums, we will do the ratios without converting this into the vertical format. Don't worry, I am going to make this chapter very simple for you, so don't worry at all. Proprietors funds, main heading is sources. As I told you, sources means money comes in. 2 sources, proprietors funds, second borrowed funds. Borrowed funds means what you have borrowed from somebody. Borrowed funds divided into 2 parts, secured, unsecured. If you see the balance sheet, there is no unsecured loan, but debentures, if nothing is mentioned, debentures are always treated as secured loan. So what you will do, secured loan 7% debentures, put it in the second column. Unsecured loan nil, so outside 20. If there were more than one secured loan, we would have put it in the first column. Got it? Again I am repeating, vertical balance sheet is the same what we did in the first chapter of this sem only. So go back if you all have forgotten. See the first video of vertical financial statement, you'll get it. I have explained that in detail. So 178 is the money which belongs to proprietors. 20 what I borrowed. So the total funds which is used in the business, we call it as capital employed, will be proprietors funds 1 plus borrowed funds 2. So 178 plus 2, 20, that is 198. 178 plus 20, that is 198. Clear? Coming to the second part, application. Now application of funds means the money what you have received, sources, where you have applied, where you have used. Therefore it is called as application of funds. That means the funds which you have, where you have applied. The funds which you have, where you have applied. Sources was in 2 parts, proprietors funds, borrowed funds. Application will be in 3 parts. First is fixed assets, second long-term investments, and the next is working capital. Working capital, you all know, it is nothing but the difference between current assets and current liabilities. Working capital also you all have in this semester. After this, the next chapter in management accounting will be working capital only. So first, fixed assets. See the asset side, all tangible and intangible assets come under the head fixed assets. See, there are few colleges who might give you the breakup of fixed assets, tangible, intangible. Also current assets may quick, non-quick. That is not required. You can just stick to this. No need for any subheadings. And in case your college, make sure to, and there's a confusion, connect with me. I'll show you in detail how to do, but it is not required. So whatever is your fixed assets, see the asset side. Building, plant and machinery, furniture, land, these are your fixed assets. Put all of them in the second column and take the total outside. So out of 198, 1,62,000 has been invested in fixed assets. Now remember, in case fixed assets have depreciation, ratios may very rarely will get, then put the fixed assets in the first column, deduct depre, and then take the answer outside. In short, the final figure outside of fixed assets has to be after deducting depreciation, if there is any depre. Second, as I told you, long-term investments. Again, investments which are made with an intention of encashing after 1 year are long-term. If you see in this sum, there are no investments only. So second heading, long-term investments is nil. In the first chapter, I have explained you in detail each and every item. So right now, I am not wasting time in your vertical balance sheet ka conversion. Third, working capital. As I told you, it is nothing but the difference between current assets and current liability. Current assets includes current assets loans and advances, but short-term loans and advances. See the asset side. You all know what is current assets. In this sum, bill receivable, I cancelled it and made it preliminary. So now what remains? Stock, cash bank, debtors, prepayments. Prepayment is nothing but prepaid expenses. These are your short-term assets, which we call it as current assets. Put all of them in the first column and take the total in the second column. Put all of them in the first column and take the total in the second column. Current liabilities. Anything which is payable within a period of 1 year is current liability. We also call it as short-term liability. We also call it as short-term liability. Whatever remains on the liability side. Tax provision, creditors for goods, bills payable and creditors for expenses. Entire list I have given you all in the first chapter, what we did, vertical financial statement. Take the total of the current liabilities. First put all of them in the first column. Take the total in the second column. Then total current assets minus current liabilities outside third column gives you the answer of working capital, that is 36,000. That is my capital employed 1 plus 2 plus 3. Capital employed is nothing but an alternate name of total, but logically it means the money invested in the business. And what you will invest, what you have got, that is the reason sources and application has to be same. So that's why we use the word capital employed. Interpretation, I got total 198. Application, where I applied, where I used it, 162 in fixed assets and 36,000 in the form of working capital. That is the way you interpret. Got it? This was the vertical balance sheet. Again I am repeating. We have done this in the first chapter, so I am not focusing much on this. I have already prepared a solution so that the calculation of ratios become easier for you. Now let's come to the ratios. We discussed right now 3 ratios. What we are going to do? Current ratio, quick ratio, proprietary ratio. I explained you all. Now let's take one by one. The first ratio, what we are going to calculate will be current ratio. First ratio will be current ratio. As I explained, you all have the theory also in front of you. Current ratio is nothing but current assets upon current liabilities. Current ratio is current assets upon current liabilities. Now, as I told you, when you prepare this vertical statement, your calculation becomes very simple because you already have the total of current assets, you already have the total of current liabilities. What's your current asset ka total? See the second column, 85,000. So, my current assets ka total is 85,000 upon current liability. How much is current liability? 49,000. So, divided by 49,000. Remember, the amount in the third column is working capital. That is the difference. I don't want working capital. I want separate current assets. I want separate current liability. So, current assets is 85 and current liability 49,000. So, divide by that. You get there 1.73. You will round it off in 2 decimals. You will round it off in 2 decimals and you will write like that. 1.73 is to 1. That means what? If my current liability is 1 rupee, my current assets are 1.73 times. I'll repeat. You will write it like that. 1.73 is to 1. That means my current assets are 1.73 times of current liability. If my current liability is 1 rupee, current asset is 1 rupee 73 paisa. That is how you interpret. So therefore, my current ratio is 1.73 is to 1. Now here we have to comment. Only where we are supposed to comment, we'll have to think of this. Now see, what I told you, the standard benchmark for current ratio set is 2 is to 1. Anything equal to or more than 2 is to 1 is good. Here it is how much? 1.73. It is little bit less than 2. So because it is little bit less than 2, you can comment that the short-term financial position is a little bit weaker. After I calculate all the 3 ratios, I'll dictate explanation. So till then, just understand. So I'll repeat, 1.73:1, which means my short-term financial position, because it is a bit less than 2:1, it is slightly weaker. This is how you will comment. Okay. Now, second, as I told you, quick ratio, we also call it as liquid or asset test ratio. The formula is quick assets upon quick liabilities. Quick assets upon quick liabilities. Now for your better understanding, I'll put the sub formula. Quick asset, as I mentioned, it is current assets minus stock minus expenses paid in advance. What I explained you. Current assets minus stock minus expenses paid in advance upon current liabilities minus bank overdraft minus income received in advance. Current assets minus stock minus expenses paid in advance upon current liabilities minus bank overdraft minus income received in advance. Go back to the explanation what I told you. Now let's substitute the figures. Current assets we have on the top 85,000. From that deduct stock. What is stock? 22,000. So from that minus stock 22,000 minus expenses paid in advance. You have prepayments. Prepayment is another name for prepaid expenses or expenses paid in advance. So deduct that 1,000. So my numerator is 85 minus 22, that is stock, minus prepayment 1,000 upon current liabilities, that is 49,000. Now from that I have to deduct bank OD and income received in advance. Now if you see, in the current liability there is no bank overdraft, there is no income received in advance. So non-quick liability is not there, so 0. I'll repeat again. Current assets may say I deduct stock and expenses paid in advance, so these two are non-quick. What remains will be quick. Same thing from current liability, I deduct bank OD and income received in advance, so these two become non-quick. What remains is quick. So my final answer will be 85,000 minus 22 minus 1, that is 62,000 upon 49,000. So 62 upon 49 gives you 1.27:1. That is my quick ratio. So my quick ratio is 1.27:1. Why I told you? What is the purpose of quick ratio? Immediate financial position. And what was the benchmark I explained in the starting of the class? Minimum 1:1. Anything 1:1 or more is a good ratio. What is it? 1.27. So why we use quick ratio? To judge the immediate solvency position. That is normally less than 3 months. So your immediate financial position is good because it is more than 1. Short-term financial position is a bit weaker because it is less than 2:1. Got it? Now the third ratio, proprietary ratio, I have a shortfall of place here, so I am just doing the calculation here. So third ratio, I will do it here. Proprietary ratio, which is, as I told you all, proprietors' funds upon total assets. Proprietary ratio is equal to proprietors' funds upon total assets. What I told you, proprietors fund means owners own money. Share capital plus reserve less fictitious, which we have discussed in the starting of the class. We have the figure ready made, 178. So your proprietors funds is 1,78,000 upon total assets. Now guys, listen very carefully. Students make this mistake. Don't make a mistake. When I say total assets, that means taking the total of the asset side of the question. Total assets includes fixed assets, long-term investments and current. Now see, if you take question ka total, remember last item is preliminary expenses. It is not a part of total assets, so the ratio goes wrong. So please don't make a mistake of taking asset side ka total. In few cases it will be correct. If there are no fictitious, it will be correct. But if there are fictitious or any other assets like any other item like calls and arrears, your answer will go wrong. So always be on the safer side. Take the total as fixed assets, which is 162, plus investments not there, plus current assets, not the working capital, current assets, 85,000. So my total assets are 2,47,000. I'll repeat. Proprietors funds 178 upon total assets, which is fixed assets plus investments plus current assets. So 1,62,000 plus 85,000. So 247. So 178 divided by 247, that gives you 0.72. So 0.72:1. That is my proprietary ratio. So my proprietary ratio is 0.72:1. Okay guys, now listen. Before I discuss the comments, keep one thing in mind. There are few colleges who multiply this by 100. It is the same thing. Now suppose you multiply by 100 now. Instead of 1.73:1, it becomes 173%. If you multiply this by 100, instead of writing 1.27:1, it becomes 127%. Here if you multiply by 1, instead of writing 0.72:1, it becomes 72%. So interpretation is same. In case your college does that, very few colleges do that, then you multiply by 100 and just express in terms of percentage. Coming back to proprietary ratio, how do you interpret? Now understand the logic I told you. 0.72:1, that means whatever are your total assets invested in business, 72% of that belongs to the owner. 72% belong, that means 1 रुपया खुद का है, मतलब 1 रुपया invested है, तो 72% is your own money and the remaining is borrowed. So what I told you, higher the owner's funds, higher the proprietor fund, it is better. So out of 1 rupee, 72% belongs to the owner, 72% financed by the owner to be exact. Therefore, the long-term financial position is good. What I told you, anything more than 0.5, 0.6 is good. Yahan pe it is 0.72. In terms of percentage, if the total asset is 100 rupee, 72% is financed by the proprietor. That is a good sign for long-term financial position. So, long-term financial position good because it is majority financed by proprietor. Immediate solvency position good because quick ratio is more than 1:1, and short-term financial position marginally weaker because it is less than 2:1. Now whatever I have explained you about the three, I'll just give you a short explanation which you will write it in your exam. Just take down, I'm dictating. Where comments are large, I will send a picture or I will send a PDF for that. Okay. Write down comments. The question is mentioned. Comments. First, 3 comments. First, the current ratio of the company. The current ratio of the company is 1.73:1. Is 1.73:1 as against the standard of 2:1. As against the standard of 2:1, which indicates that the short-term financial position of the company, is marginally weaker, because it is not too bad, marginally weaker. I'll repeat again. The current ratio of the company is 1.73:1 as against the standard of 2:1, which indicates that the short-term financial position of the company is marginally weaker. Okay. Second, see, I am making it very short, I am making it precise so that you understand the concept, and writing the comments also becomes easier. These comments in exam, only if the question says to comment, then you have to comment. Otherwise, you just have to calculate the ratios and leave it. Second, quick ratio of the company is 1.27:1. The quick ratio of the company is 1.27:1 as against the standard of 1:1. As against the standard of 1:1, which indicates that the immediate financial position of the company, position of the company is good. I repeat, the quick ratio of the company is 1.27:1 as against the standard of 1:1, which indicates that the immediate financial position of the company is good. Okay. Next, third, we discuss long term. Right now, the proprietary ratio of the company is 0.72:1, which indicates that the major portion of assets are financed by proprietors. Major matlab 72%. So 100 में से 70 would become major only. Are financed by the proprietors. Therefore, the long-term financial position of the company looks good. Got it, guys? So that's it. It's become an extended video. So this was the thing. I gave you the brush up of ratios, the classification of ratios, balance sheet ratios, revenue or income statement ratios, third combined. We discussed in detail what is balance sheet ratios, and we have done the first 3. As I told you, there are 6 balance sheet ratios, but this being the first lecture, the first session, I'm just getting into the first 3. In the next class, we will revise these first 3 as well as the 4th, 5th and 6th one. And again, I'm repeating, those who don't remember the format, please go back to the first chapter, first class, where I've done everything in detail as far as the vertical format is concerned. That's the reason I did not waste time here. That's it, guys, for today. Hope the concept is clear. Again, I'm repeating, please don't try to mug up the formulas, understand logically. And I'm telling you all on the first day, after I complete this chapter, what you all do now, I'm telling for your benefit. Whether you all do or no, it's up to you. Write down all the ratios at one place together, not now, after we finish the chapter. Write down all the ratios at one place in your own handwriting. Don't take Xerox from somebody. If you do that, you will understand and you will remember the formulas in a much better way. After we finish the chapter, all the ratios what we are going to study, write at one place in your own handwriting, it will become much easier to remember and refer a day before the exams. It's in your benefit whether you all do or not. Okay? So that's it for today. See you all in the next class where we'll study these three ratios again plus the another three. So total 6 balance sheet ratios we will study in the next class. And after that another 2 to 3 class we will do calculation and revise all the 6 again and again with different variations of calculations and different items also. That's it guys. See you all in the next class. Till then, take care.